Major support for these programs is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank, Chase Commercial Term Lending, Chelsea Lighting. Additional support is provided by Briarwood Organization, Bruce Mosler, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Hal Fettner, Durst Fettner Residential, Friedman LLP, Accountants and Advisors, Flushing Bank, Gemini Real Estate Advisors LLC, Genova Burns, Giantomasi and Webster, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, Corman Communities, Madison Realty Capital, Margolin, Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, the Wickoff Group, Urban American, and Ackman Ziff Real Estate, Aerial Property Advisors, Eastern Consolidated, Essex Capital Partners, Goldman Properties, Moynihan Group, Musk Development, RAL Development Services, the Spandrel Group, LLC, Rosewood Realty Group, Terra CRG, Triangle Equities.
There are young, dynamic real estate executives. You know, sometimes, you know, they're in the field of real estate, and, you know, they have their ideas of what are the right assets, where should they go? Because as I said on earlier shows the last couple of weeks, you know, there's like an irrational exuberance that the world is coming back to 2007. So today I've assembled 4 individuals, all under 40 years of age, one even under 30, I believe, to provide their insight on the state of their market and where their thoughts it's going. I have David Speiser, who is a managing director at Madison Realty Capital. I have Danny Rudin, who is an associate at Angelo Gordon, a prominent world-renowned private equity fund. I have Dan Jacobs, who is the vice president at M&T Bank. And last but not least, I have Winston Fisher, who is a principal at Fisher Brothers. So on the age situation, though, I think I have similarities over here, the youngest over here. How do you look at the market? And, you know, Fisher Brothers has been around close to 100 years.
Close to.
In New York and around the country. How do you see the market? Are we at a time, as I was saying, is it irrational exuberance? The world's getting too good? I mean, people think it's the best market, or is the market where you guys are, New York and Washington, the major areas? What do you see?
I think New York and DC to some extent, but New York it's clearly gotten frothy again to some extent. I think as we are seeing things get bid up. I mean, it's no secret that commercial office buildings, at least as of 6 months ago, were selling for, 4, maybe sub 3, multifamily. One of the things that has remained reasonably consistent even through the crisis is that equity wants to be in New York. And as the world gets more turbulent, more and more equity wants to be in New York. And so that doesn't, just because some equity wants to be someplace doesn't mean that prices will hold up forever, but I don't see it having, the wild down swings that some part of the other countries have, parts of the other country. New York is reasonably safe today. The big unknown for us, candidly, is political risk. I think that's the one area that we can't handicap.
But on a political risk, you have a potential 2 political risks. You have the presidential political risk
up
there.
and down the spectrum.
Right, and then you have the political risk in New York, who's going to take over for Mike in that administration.
I think
there's a double combination over there, because what has happened was over there. How do you look at it? You've been around. You've played. Worked for a prominent law firm, and then you were with the related companies, and now you're with Madison Realty Capital. So you've seen different markets. Which markets do you think are the best opportunities?
I think there's a lot of opportunity in the boroughs. New York City is an oasis. New York City is, there's only one New York City. And you have a lot of people.
You live in New Jersey.
I live in New Jersey, but there's only one New York City. And you have a lot of people who make a very nice living who want to rent a luxury apartment. You have a lot of people who make a very nice living who want to own a luxury condo, and they're priced out. And so you have prices in Williamsburg, you have prices in Queens, you have prices in Staten Island reaching levels that are close to where they were in 2007 because there are only so many places to go where you can take one subway stop to get to New York City.
You guys have been involved in the boroughs. You've been involved with Long Island. How do you look at the boroughs and the suburbs?
Yeah, I think that our involvement in the boroughs thus far hasn't been on the, so much of the residential, but we did have some office properties in Long Island. I think that, the suburban markets took more of a hit, obviously, than, core Manhattan, core New York did, core New York City. And obviously the reason for that, like David said, is, you're dealing with a smaller amount of land and a limited supply of buildings.
Now, you seem to be interested in retail, but big box retail and, the warehouse stores. Have you, besides the BJ's wholesale, where you have one plan for Garden City and one at the former Stella D'Oro facility up in the Bronx, what else is Angelo Gordon bullish on today or positive with regard in the local area?
I think, both of those opportunities were extraordinarily low bases for us to get into. The wholesale clubs are great. I think when it really comes to retail and being bullish on retail, you have to make sure that there's tenant interest. It's all about your basis and the tenant interest. And if those two things exist, low basis and demand from tenants who want to be there, look, I'm not as good as the guy who is finding the next location for any wholesale club or any retailer for that matter, at knowing whether the demand is there for the exact product that he wants to sell. But if he's telling me it's there, and that's a location where he wants to be.
Now, here's the situation. People can be telling you that. They have to go to their banker, who's going to say, how are you making your judgment on what's a good deal and what's a bad deal?
Well, in the situation that Danny's talking about, we certainly like when there's a tenant involved.
I understand, but I'm talking, forget Danny's specific involvement. I'm talking about, look, M&T has been a major player in the New York City, Long Island real estate market for a number of years, probably one of the top 3 prominent players, with a great marketplace over there. What do you like today? What do you want to see? Where do you feel comfortable, and where are you a little scared?
Well, I think this discussion always, from M&T, always starts with sponsorship. And I think that we have a fantastic group of customers and clients, and we've certainly built that out over the past couple of years. But doing business with the right people, I think we're looking at all different asset classes. Multifamily, we're not afraid of construction, whether it be rentals or condominiums. We're certainly long condominiums in New York City. We think that there is opportunity there. We did a number of projects. We're in a number of projects in the city, less so in the boroughs.
So here's the question, and I don't want to be Manhattan-centric. I was joking, but I wasn't joking. You live in New Jersey. Certain people say Hoboken, Jersey City, or the 6th borough or something like that. You don't live in Hoboken, Jersey City. You live in Bergen County. There is development taking place in Newark, but most people don't want to go to Newark because there's nothing really there. I tell the story about going into the arena. You go to the arena and you make sure you leave right after the arena. You don't stay around Newark in certain markets, and nobody's really been investing over there. How has Fisher Brothers, have you, you said you're doing work in Manhattan, with some condos, some other projects, and in Washington. I want to pose this to both of you. What's your thoughts of New Jersey?
We have not operated in New Jersey. I think that, as we were talking about, if you look at along the waterfront in New Jersey and what's happening in Lower Manhattan, it should only get better. I think there's going to be rental opportunities, condo opportunities. With all that comes retail opportunity. I'm somebody who's a big believer in New York City over the long haul. I mean, it gets back to, and because of that, places like Jersey that are in close proximity, a rising tide lifts all boats.
Right, but perhaps those main markets close to New York City,
Yeah,
as opposed to perhaps the Morristown. Or,
I
tied to
wouldn't honestly be
transportation.
qualified
Right.
to speak on that.
To me, it's tied to transportation. When you're talking
Yeah.
about Hoboken, when you're talking about Jersey City, you're a train ride away from downtown New York City. When you're talking about Bergen County, as much as I love it, you got to get in your car and you got to drive to New York City, or you got to sit on a bus. It's a different type of commute. And like I said before, everything is about it's about transportation to New York City. And you're not going to sell a multifamily building in New Jersey to in Bergen County, New Jersey, to young professionals who have to get to work in the morning at 8 o'clock in the morning when it's going to take them an hour and a half to commute there.
I mean, New York, if you look at it, I mean, when we talk about why is New York, whether it's the boroughs or Manhattan or any place, New York is a much safer place to raise your family today. I grew up in the city. It was not a safe place. Everything today is cleaner. The suburbs, people are now, all the kids are going off to college. They want to be in New York. Where do you want to live? You want to live in New York City. I mean, everything about New York is positive. If you want to do business, where do you want to do business? In New York City. You like the human capital and the cultural experience that surrounds it. All that does is mean, I think that just lifts Manhattan, and everything else comes along with it. Are there blips? Of course.
Now, has Fisher Brothers or will Fisher Brothers, you and what you plan, do you think you'll go to the boroughs?
I could see us in Brooklyn potentially. We're not looking at anything, but is there opportunities? We like to be, we're urban, high-rise owner developers, and that's what we'd like to own. Is there that opportunity in Brooklyn? Potentially.
Now, I was reading that in one of your great buildings, 1345 Avenue of the Americas, you're going to take, where you have the fountains right now,
Right.
and do some retail. What are you planning to do there?
I mean, that's an opportunity that we have 15,000 square feet of below-grade space underneath the plaza. We've got these two fountains, and that you can turn them into something. Obviously, we got our inspiration from the Apple Store, but it's a chance for a tenant to come in and, design something that's tasteful, elegant, and timeless to be their literally flagship store. 40,000 people walk by that site every single day.
You're right next to the hotel.
It is a dynamite retail location.
Now, if someone hasn't told you, but I will tell you, you may be aware that Microsoft has started to open up stores. They recently opened up in the state of New Jersey 2 stores on the same levels, one in Freehold and one in I think 287 in Morristown, across from the Apple Store. And I wouldn't be surprised if
anybody out there, whether it's a sporting affiliation or electronics, this is a chance to do a staple, highly visible, iconic retail structure. There's not that many opportunities in New York. We know what's success of Apple, and this has the same. In fact, it really has, when you look at the people coming in and out of there, whether it's the weekends or weekdays, unbelievable traffic.
There's no question over there.
Yeah.
How do you look at retail, banker?
Well, we like retail. It's a fair bit of it in the portfolio. Much of it CBD type stuff throughout the boroughs and in New York City. It's performed well year over year. It's a great asset class.
Now, we talking about asset classes, and as you were saying to me earlier, that, with the RTC, Fisher Brothers purchased a lot of hotels during the period of time. And, today you have, in my opinion, one of the finest hotels in Times Square, with the Crown Plaza over there. How do you look at the hospitality market? And I'd like to pose it to you, Winston, and to everyone else today. How do you see that?
There are some concerns today in New York City that there isn't a lot of new supply coming online, and I think you can't ignore what's happening in Europe. That's having an impact and will continue to have an impact. So, but overall, I'm appropriately bullish on New York City. I don't see people want to come here and visit. I think with the rise of Asia, that's only going to help.
You know, it's
you know.
it's very interesting because the other day I did a panel and I had Gary Barnett and I basically said, you know, the euro, and his comment, he says, the Asians, the Casitans, the Brazilians, the Argentinas, the Far East, doesn't matter. They'll be replaced.
I think short term you could have some. I mean, you know, listen, it doesn't mean anything's immune. Stuff does not go straight up, but hospitality in New York City, I mean, it goes back to the thing, why people want to live it. It's a great.
It's a great mecca.
Yeah.
You guys, hospitality. I mean, you're converting a hotel location, not a hotel location, probably the premier location in the Plaza District, you know, with the Carlton House. How do you look at the hospitality? What's Angelo Gordon's
I think, you know,
thoughts on hospitality?
I think we would say the same thing. You know, I mean, I think that you need to be careful about where you're getting into it. I think personally, I have views on Manhattan and the boroughs that there are a lot of rooms coming online in the next 5 years, you know, way more than we've experienced in the last 10 years on historical averages. So I think I'm a little bit less bullish in Manhattan and the boroughs for a hotel. That being said, you know, I mean, I think it's an okay place as long as your basis is right.
Now, you guys, you're hotel lenders. You like hotels.
Well, I think we do appropriately. I think there is some concern. Preface it by saying that hospitality is handled in a different group. I'm in the.
I'm
commercial real
talking the
estate
bank
group.
in general.
I think there is the potential for there being an oversupply. Whether all the projects that Danny probably sees on a daily basis get built, financed and built, is a very different story. But there is the potential for oversupply.
Here's the question. I don't want the banker to answer it. I'd like the borrowers to answer it. How do you see 2012 for the availability of financing as compared to 2007? Is it similar or
Better?
Or better? Or better?
I mean, capital's available. The problem is not capital today. I mean, if you're trying to do a 90% loan, 10% equity, okay, that market's gone, or it's going to be much more challenging. But if you're borrowing 60, you know, if you're trying to borrow 65, 70%, maybe a little mezz debt 75, and you have equity, and there's plenty of equity available, spreads are as tight as they've been. There's more, you know, people are aggressively bidding. It's finding product that's the hardest thing. It's the right product. It's not. I think availability of capital is, it's flush.
David?
I agree, absolutely. I think that the lenders are being more careful. They're making sure that their sponsors are the right sponsors, and then they're making sure that the projects aren't over-levered. And like Winston said, the money's there. It's the projects that you have to make sure are the right projects.
Now, you know, Winston brought up earlier, we were talking about the office market. You know, it was very frothy. You know, people were paying at very high multiples. Now, in the second quarter, we've had a lot of leases renewals as opposed to new relocations. And that doesn't really help the market. It helps the market that they're leasing renewals, but it's a softer market over here. We have developments coming on in the Hudson Yards. We have the developments in Lower Manhattan coming on. Do you think the office market is going to be able to absorb this that quickly?
What's quickly? I mean,
2 to 3 years?
Well, I don't think
that's not,
they're not even Hudson
right.
Yards.
These
Do I
projects
think the
aren't
market
coming
will
on in 2
absorb
to
Hudson
3
Yards?
years.
Of course, it's going to be great buildings. I mean, it's
No,
going to
I
define an area.
I think maybe
but it's not being built today.
Okay, I
not.
think my comment is, do you think there's an opportunity? I mean, there are certain spec office buildings being built today. Besides that, there's the Heinz building being built on the corner of 40th Street and 6th Avenue. There is the Minskoff's property in Cooper Square. There are a couple of spec buildings. Do you think that the office market could afford certain spec buildings to be built today? New spec buildings in addition to the other properties.
Brand new buildings will probably lease up. It's a question of basis. I mean, if they all have to achieve, if their pro forma requires averaging $95 a square foot in rent for an entire building, I think they're going to have some trouble. If you're talking, I mean, the size of this market is what, 400 plus million square feet.
Yeah, what's 2 million?
Yeah, I mean,
what's a half a million square feet?
Can the market absorb it? I think the market's soft today. I think that, I mean, we see it. We're 100% leased, thank God, you know, the way we do our portfolio. But it's soft out there. I mean, everything says financial services are soft. It comes back to accurately answer that, you really have to look forward 12 to 18 months. What happens with the debt ceiling? What happens with the Simpson Bulls? What's the grand bargain that gets in place? I mean, all of these things, it feels like we could explode or we could crash if we get it wrong.
Right, and here's the very big problem that, you know, perhaps Dan will address, and I think everyone else. You know, today you can refinance multifamily at unbelievable rates. I mean, you know, you can get 5, 7, 10-year money under 4%, as low as 3% on 5 or 7-year multifamily from certain lenders. 5 years, the world changes. So you don't know what it's going to be in 5 years. One, real estate taxes in New York are outrageous. Water and sewer are up. And then if you buy a building which is older, there's deferred maintenance. And what we have in New York City is also we have local law 9, 10, 11, 27, where, you know, I was joking, you know, I'm happy that the apartment building I live in does not have terraces, because whenever I pass a building that's 20, 30 years of age, the terraces, you have to rebuild the terraces. That's a major expenditure, you know, for the parapet. What happens in 5 years? You're a private equity fund. He's a private investor. You're a private equity fund, but in a different manner. How do you look at, you know, you're talking to your investors and you're telling them that you're going to try to get them a 15 to 20% return, right? How do you?
We have two different strategies. So we have a core plus, and then we have an opportunistic strategy. And I think that, again, you know, I think one thing that's consistent with all of the deals that we underwrite and do is that we're not underwriting based on assumptions that are carrying today's values or today's assumptions back to a market recovery. We're underwriting today based on the assumption that we're going to be able to acquire a property or carry out a business plan with what's going on in the market today. So I'm not looking at an office building and underwriting 5 years of 10% growth or 5 years of double-digit growth every single, you know, happening every single year, and then taking it to, you know, M&T and asking them to finance it. Because, you know, getting back to your question earlier, we see financing coming back for the right projects. That being said, lenders are concerned with sponsorship and what it's going to look like in their takeout year. Too many people got hurt.
Now, all of a sudden, you guys went to suburban. You went to New Jersey to buy a lot of garden apartments, right?
Mm-hmm.
How come you're so bullish on the apartment building business in New Jersey? I'm bullish, but I just want to hear from your perspective.
I think in general, multifamily is an incredibly healthy sector. I think our basis there is good. You know, those are strong cash flowing assets. We saw a lot of opportunity with respect to how they were being operated in terms of expense management, and also just how they were being marketed on the revenue side, ways to increase rents. So, you know, in general, I think multifamily is a strong sector. I think that those are perfect examples of kind of, you have a strong sector where you'd like to be a player, and you have an opportunity to get into a property that, you know,
now,
there's real upside.
Here's an interesting question. I think it relates to David and it relates to Winston. Winston was saying, you know, in the 90s, they were buying a lot of distressed debt. Madison buys a lot of distressed debt. Are the opportunities still around to buy distressed debt?
Yeah, absolutely. I think a lot depends on the price range that you're looking at. When you're looking at $50, $100 million debt pools or notes, the competition is fierce, and you're competing against people with lower cost of capital, and things get bid up significantly. And you're competing against much more institutional investors. If you're looking at, you know, something in the $5 million range or even up to $30 million, there's not as much institutional capital out there looking at debt in that price range, and there's a lot of opportunity to find good deals.
Are you looking at distressed debt these days?
We'll look at it. We're not. I mean, I think what you touched on is that these big pools are getting bid up. It's not the RTC. I mean, it's nothing close to what the RTC was today. I mean, there was no capital available. Today, there's actually tons of capital chasing distressed debt. you don't see much of it in New York City. I mean, if you want to go distressed debt, fine. Is there stuff in Atlanta? God bless, enjoy. But like, what's distressed in Manhattan?
I think
There's things, but
I don't know. I don't know if everyone would agree, but I think the FDIC pools put those aside because those are different, and I totally agree. I mean, once
Right.
you start looking at stuff like that, you're talking about a totally different animal. You're
Right,
talking
let's talk about
going
the
up
regular-
against, club deals with huge institutions. I'm talking about regular distressed debt. I think that we saw a good amount of it. We were able to acquire a lot of notes, in the past few years. We're not seeing as much of it today, but does that mean that it's not going to exist shortly in the future? I don't think so at all. I mean, you have over $1 trillion worth of debt coming due, in the next
Right,
what is it,
all
5
the
years or so.
2000 all the 2007, 2008 deals.
Right,
I mean,
right,
it's
exactly. So to
recapitalization,
think that there won't be opportunities going forward. I mean, I think there will definitely be opportunities going forward in Manhattan, in particular, or countrywide. Really, I'm not seeing as much of an opportunity today.
But what's this? I mean, also stuff is a recapitalization, right?
Exactly.
I mean, like somebody they got land or they had a construction loan stalled, they buy it, they got to
Right.
start again. I mean, it's,
I mean,
listen, one of the
related
great things about New York is, get back to why is New York so, it's liquid. I mean,
it relates to Winston's comment. Last year there were a lot of investment sales. 40% of them were recapitalizations of assets over here.
Yeah.
New York City and the area is the mecca of education. I mean, you have more education. We were talking on when I did my show in Brooklyn that downtown Brooklyn has more students than Cambridge has in the market. So to house these students, especially since there's not enough residential apartments to house the regular people, do you think there are opportunities in the student housing and the dormitory perspective? And do you think that's something that maybe Fisher Brothers, or do you think you'd finance? I know that Madison Realty Capital a number of years ago were the only lenders, because it was in 2008 when somebody was building a dormitory 2 blocks from Brooklyn College. No bankers wanted it because of the time and the inexperienced borrower. It worked out great for Madison. They had a great return and so on. Do you think that's a market?
I mean, listen, we're conservative entrepreneurs. So
We're conservative entrepreneurs.
But to the extent that it makes sense, could you find a mixed-use project where you say, I've got a great opportunity, I'm going to build rental, this is phenomenal, it makes sense, I'm going to put student housing in the base of it. Are we probably going to build a dorm, just a dorm? No, but then again, how much money can we make?
No question.
I mean, come on.
It's a question of return. So
we're not in it till it makes a lot of sense to be in it.
Okay, so I think that we've accomplished. We got some good ideas and thoughts on where the four of you see the outlook and the opportunities. And I'd like to thank my guests today, David Speiser, Danny Rudin, Dan Jacob, and Winston Fisher. And I'll see you next week.